In 2023, the personal investing industry managed approximately $30 trillion in retail assets. It also produced an entire media ecosystem: newsletters, podcasts, YouTube channels, brokerage platforms with GI feed interfaces designed to keep your attention focused on the performance of those assets approximately 16 hours a day. The average retail investor checks their portfolio more than once per trading day. They spend more cognitive energy monitoring the Federal Reserve's language around rate decisions than they spend thinking about the single variable that will determine their financial outcome more than any other over the next decade. The variable is not their asset allocation. It is not their expense ratio. It is not whether they pick Roth or traditional. It is how much money they make, and more specifically, how aggressively and systematically they are growing. The investing industry has a structural interest in your attention that is worth naming clearly before going any further. Every hour you spend optimizing your portfolio is an hour you could have spent increasing the income that funds it. The industry profits from assets under management, trading volume, and the anxiety that keeps you engaged with platforms designed to monetize your engagement. It does not profit from you negotiating a $15 zero salary increase, developing a skill that makes you worth $40 zero more per year, or building a client base that generates $80 zero in annual freelance income. Those activities move your financial life more than rebalancing ever will, and they receive approximately zero coverage in financial media because there is no product to sell around them and no commission to collect when they succeed. Here is the arithmetic that most personal finance content buries because it requires saying something unflattering about the investing industry's core product. A 25-year-old earning $55 zero per year who saves and invests 15% of their income, $8, $250 annually at a 7% real return, will have approximately $2.10 million at age 65. That is the standard model. Now run the alternative. The same person, instead of spending the next 3 years obsessively optimizing their portfolio allocation, spends the cognitive energy on developing skills and positioning that increases their income to $80 zero by age 30. They still save 15%. Now they are investing $12 zero per year instead of $8,250. At the same 7% return, they retire with approximately $3.10 million. The $25 zero income increase generated $1 million more in retirement wealth, not through superior investment returns, not through lower fees, not through better asset allocation, but purely through a larger contribution-based compounding over time. And that is a conservative example. A $25 zero income increase at 30 that compounds through promotions, raises, and career development into a $50 zero income differential by 45 produces a retirement wealth gap that makes the investment optimization conversation look like a rounding error. The behavioral economics of why people focus on investing rather than income are not mysterious. Investing feels controllable in a way that income development does not. You can open your brokerage app right now and make a decision. The feedback is immediate. Numbers move. You feel engaged. You are doing something. Income development is slow, uncertain, often requires other people's decisions, and produces no dopamine hit on a Tuesday afternoon when the market is flat. The investing app has been engineered to be more compelling than the work of becoming more valuable. The engineering serves the app's business model, not your financial future. The slot machine is more engaging than the library. That doesn't mean the library doesn't build more. Let's be precise about what income actually represents in the wealth building equation, because it is systematically underweighted in how people think about financial progress. Your income is not just a flow of money. It is the raw material from which everything else in your financial life is built. Your savings rate is determined by the gap between your income and your expenses. Increasing income widens that gap without requiring the behavioral sacrifice of reducing spending. Your investment contribution amount is capped by your income and savings rate. A higher income, at the same savings rate percentage, produces a geometrically larger portfolio over time due to compounding. Your access to wealth-building debt, mortgages on investment property, business loans, favorable credit terms is largely determined by your income. Your ability to weather financial shocks, job loss, medical events, market downturns without liquidating investments at the worst possible time is a function of income stability and growth. Fix the income variable and nearly everything else in the financial model improves simultaneously. Fix the asset allocation and almost nothing else changes. The human capital framework gives this intuition a more rigorous foundation. Economists define human capital as the present value of your future earnings stream, everything you will earn from now until you stop working, discounted to today's dollars. For a 30-year-old earning $70 zero with reasonable career trajectory assumptions, the figure runs somewhere between $1.50 and $2.50 million, is almost certainly the largest asset on your personal balance sheet, and it receives almost none of the management attention that $50 Zaro investment portfolio does. People spend hours researching which index fund has a 0.03% versus 0.05% expense ratio, a difference of $10 per year on a $50 Zaro portfolio, while spending zero structured time on the management and development of an asset worth 20 times the portfolio's value. This is not irrational in the sense of being incomprehensible. It is irrational in the sense of being precisely backwards. The largest asset you own is the one you are least deliberately managing. Here is where the analysis needs to get specific. Because increase your income is advice of the same quality as lose weight by eating less. Technically correct. Operationally useless. The mechanisms through which income meaningfully increases for working people fall into three distinct categories, and they have different risk profiles, timelines, and capital requirements. The first is skill premium capture within your existing career track. Every profession has a distribution of compensation in the 25th percentile, the median, the 75th percentile, the top decile. Moving from the median to the 75th percentile in your field requires, in most cases, a combination of specialized expertise, demonstrated outcomes, and the willingness to negotiate and change employers when internal advancement stalls. The income difference between the median software engineer and the 75th percentile software engineer at the same experience level is approximately $40 per year in current market data. For a nurse practitioner, it is approximately $25,000 for a project manager. Approximately $20,000. These are not gaps that require career changes, advanced degrees, or entrepreneurial risk. They require developing expertise in the highest value subset of your current role, documenting outcomes and terms employers respond to, and being willing to have the conversation or change the employer when the market rate and your current compensation have diverged. Most people never have that conversation. The income gap between those who do and those who do and those who don't is the largest source of unexploited wealth building capacity in the American workforce. The second mechanism is credential and skill investment with a calculable return. This is the category where the advice gets complicated by the student loan catastrophe we discussed earlier. Not all educational investment produces a positive return, and the personal finance industry's blanket endorsement of advanced degrees has caused significant financial harm. The targeted, specific skill development in areas with documented compensation premiums produces some of the highest returns available in household finance. A nurse who spends $3.00 in 6 months obtaining a certified registered nurse and esthetist track certification adds $60. Zaro, Sanity absolutely wealthy. 0 to $80. Zaro an annual earning potential. A data analyst who spends 200 hours and $500 on Python and machine learning certification increases their market value by $15. 0 to $25. Zero annually. A project manager who obtains PMP certification, approximately 35 hours of study and the $400 exam fee hands an average $20. Zaro salary premium in current market data. These are not speculative investments. They are documented, calculable returns on specific human capital expenditures in markets with measurable compensation data. The return on invested capital for a targeted professional certification regularly exceeds 0% in the first year alone, a number that no investment portfolio will ever approach and that receives no coverage in financial media because there is no asset under management to charge fees on. The third mechanism is the one that the income development conversation usually avoids because it requires confronting the most uncomfortable variable in personal finance negotiation. Compensation research consistently finds that employees who negotiate starting salaries earn $5, 0 to $10, 0 more in their first year than those who don't. A gap that compounds through every subsequent raise, which is typically calculated as a percentage of current salary for the entire duration of that career. $7. Zero negotiation win at age 25, compounded through 3% annual raises over a 40-year career, generates over $360. 0 in additional lifetime earnings. That is from one conversation that most people decline to have because it feels uncomfortable. The discomfort is real. The cost of avoiding it is $360,000. And yet the personal finance industry dedicates infinitely more content to the difference between a 0.04 and 0.06% expense ratio than to the mechanics of a salary negotiation, because the expense ratio difference is a product feature they can market, and the negotiation is a skill they can't monetize. The principle underneath all of this is one of leverage ratios. Your income has a leverage ratio on your financial future that no reasonable investment strategy can match. A 20% increase in income, maintained and invested at the same savings rate percentage, produces a 20% larger contribution base compounding for decades. A 20% improvement in investment returns requires sustained outperformance of the market by 20% annually. Something that essentially no one achieves produces a smaller absolute dollar impact over the same period for most retail investors because the contribution base is smaller than the portfolio size for most of the accumulation phase. In plain terms, for the first 20 to 25 years of your working life, the amount you put in matters more than the return you get on it. This is a mathematical truth that the investing industry would prefer you not dwell on. This matters right now because the labor market of 2024, despite softening from its 2022 peak, still shows significant skill premium dispersion. The gap between what the same role pays at different employers, in different markets, and at different skill levels, remains historically wide. Remote work has expanded the addressable market for high-skill workers in ways that make geographic salary arbitrage working remotely for a high cost of living market employer, while living in a lower-cost area more accessible than at any previous point in economic history. The tools for skill development, online courses, certification programs, professional communities have never been cheaper or more accessible. The friction between your current income and a materially higher income has never been lower, which means the opportunity cost of spending your finite cognitive energy on portfolio optimization has never been higher. The investor who spends the next 5 years perfecting their asset allocation will, if they're good, outperform the market by perhaps 0.5% annually, a victory that requires constant attention, significant emotional discipline, and produces a modest dollar advantage on a portfolio that is, at this stage of most people's lives, still relatively small. The professional who spends the same 5 years deliberately and systematically increasing their earning power will, if they execute the mechanisms described here with reasonable competence, increase their income by $30, 0 to $60, 0 annually permanently, compounding, funding a larger portfolio that then benefits from the compound returns everyone is so focused on. The market will do what it does. You cannot control it, time it, or consistently be it. Your income is the one variable in your financial life that responds directly and proportionally to deliberate, intelligent effort. It is the lever you actually control. Everything else is just optimization at the margins of a number you haven't maximized yet. Stop watching the portfolio. Build the income. The portfolio will grow and the income does. The reverse is considerably harder.